Hello everyone, welcome to Accounting 312. In this video, I will talk about Chapter 9, Inventory Costing. So in our class, we will focus on the first three learning objectives from your textbook. And then basically, there are three main things you have to know. So the first thing is related with our balance sheet, which is how do we find out the costs of our inventory, right? So what costs should be included as our inventoryable costs under variable costing and under absorption costing. And the second thing is how will the difference affect our operating income? How about our income statement, right? How about our operating income under our variable costing and absorption costing? And then the third one is in the reality, what managers will do, or like some small other things that we want to go through together. So let's go ahead and first do the first one. What will be included as our assets as the inventory? So what costs will be included? You have your PowerPoint, so I just go through very quickly with you. Basic idea is we talk about what's the cost of your inventory, and then we have all the definition, variable costing, and then absorption costing. I'm not going to really read, but you need to know first, no matter what costing talking about, they have to be first the costs that are included in the inventory. First requirement is they have to be manufacturing costs. There is no difference for those methods. They have to be your manufacturing costs. So all the general administrative, sales, our accountant costs. So those are all period costs, no matter under absorption costing or under absorption costing, variable costing or under absorption costing. So they have to be first the manufacturing cost. They have to be manufacturing cost. The main difference is variable costing, we only think about variable manufacturing. And absorption costing, think of the variable and fixed manufacturing costs. So it absorbs all the manufacturing costs. So now you can see it that the first three, direct labor, direct material, and then direct variable manufacturing overhead, there is no difference for both methods. So these three items, they are always your product cost, they are always your inventoryable cost, they are always your manufacturing cost. And then the variable sales administrative, fixed sales administrative, this is not manufacturing cost. So there is no doubt they are period cost for both methods. The only problem here is how do we treat our fixed manufacturing overhead? How do we treat our fixed manufacturing cost? Under variable costing, it only takes variable manufacturing costs as the product cost. So your fixed manufacturing cost will be the period cost. Under absorption costing, it absorbs all the manufacturing costs. So fixed manufacturing cost will be part of your product cost. Okay, so that's the first thing you need to know. We will do practice later, but I just go through the PowerPoint first with you. And then this is our first part, basically. How do we take our balance sheet? How do we find out our cost of our inventory, right? How do we find our cost of inventory? So the second part, then talking about how this will affect your operating income. How will this affect? So we got this one, we found out that the only difference is how do we treat our fixed manufacturing cost, right? Under variable costing, it is your period cost. Under absorption costing, it is your inventoryable cost, right? Product or whatever inventoryable cost. So now, how will this affect your operating income? How will this affect your operating income? Okay, so we are good for this one. Now we look at the second one. We said under variable costing, there is no really a big deal. It's always your revenue. We said minus all of your variable costs gives you contribution margin, minus all of the fixed costs gives you operating income. So I don't really worry too much. You just get all of your variable costs, you get all of the fixed costs. For absorption costing, you have your revenue, you minus your cost of goods sold, or your gross margin, you minus your non-manufacturing cost, you get your operating income. So the key item here is your cost of goods sold. Is your cost of goods sold. Remember that you manufacture all the inventory and they are sitting as your asset in the balance sheet. You will not expense them until they are sold as a cost of goods sold. So this is in your balance sheet. This is in your income statement, right? We are talking about operating income now. It's in your income statement. So how can you expense your inventory and put this as your cost? You only do this when you sold, so you need a step is when you sold your inventory. When you sold your inventory, the inventory cost became your cost of goods sold. And then you match it with your revenue, you get your gross margin. So they have to be sold. The problem is, if you produce the 5 units, you sold all of them. That's perfect. All of the 5 units, the cost will become cost of goods sold. But if you produce the 5, you only sold 3, you still have 2 sitting in your warehouse as the ending inventory. Can you expense 5 units as the cost of goods sold? You cannot, because you only sold 3. So all you can do is you only expense 60%, right? 3 out of the 5 cost as from your inventory to your income statement. The other 2 will still be in your balance sheet as your ending inventory. So this is the general picture. This is you have to understand the logic. You have to understand the logic. So if you produce more than sale, some of the costs will not be expensed because they are not sold. They are still your inventoryable cost. They are not cost of goods sold. You cannot deduct it in your income statement. It's not going to the operating income. It's sitting in your warehouse at the ending balance in the balance sheet. Okay, let's do a problem. Hopefully you will feel better. So I made up a question. I posted this to the Blackboard also, and then give you the information. So I said you are making the candy, and then you have this information: direct material, direct labor, and then variable manufacturing overhead. And you also had $20 total for fixed manufacturing costs, all right? And then other non-manufacturing, you have all these, and then you have this. So I just go with you for the first year. You said, hey, let's get the first situation is you made 5 bags, you sold 5. So our first step is I always suggest you to do that 2-step, although you may not think it's useful, is safer. So our first step is we always get the inventoryable cost for each product, right? For each product. Under variable costing, you only have a direct labor plus direct material plus direct labor plus your variable manufacturing cost, right? Because you only use your variable manufacturing. You only use your variable manufacturing. Gives you 1 plus 2 plus 3 is 6 each. And under absorption costing, it's all this, right? Direct material, direct labor, plus variable manufacturing overhead. But we also need to add our fixed manufacturing cost, right? Because it absorbs all the manufacturing cost as long as it's manufacturing cost. So we get 1 plus 2 plus 3, and how do we get the fixed manufacturing overhead for each unit? You used $20. You used $20. And then you manufactured 5 units, right? You produced 5 units. You spend $20 and you got 5 units. So each unit, if you have learned the cost accounting, you have to allocate it, right? You have to allocate it. So each one will be 20 divided by 5. So this is our allocated fixed manufacturing cost. So you get this 1 plus 2, the 1 plus 2 plus 3 plus 4, right? So you got $10. So you can find out that for each unit, your inventoriable cost and the absorption costing method will be $4 more than under variable costing method, because you allocated the $4 of the fixed manufacturing cost, attach it to your product, to your inventory. So for each unit, under variable costing method, if you like, you have candy or you have the pencil, under variable costing, this is $6 the cost. Under absorption costing, this will be $10, because you attach the $4 of the fixed manufacturing cost to your inventory. Okay, so that's the first step, and then it asks you about your operating income. So I do this quickly, and then if you already have the notes, that's good. If you don't, then you can just go with me very quickly. First year is kind of straightforward. It's at the variable costing, and then we have our absorption costing. It's always your revenue minus your variable cost gives you contribution margin, subtract fixed cost gives you operating income. Revenue, you sold 5 units, $40 each, so it's 200. We subtract our variable costs. We don't care it's manufacturing or not, so it's 1 plus 2 plus 3 plus our 6 of sales, and then we time our 5. We got our $60. So we got our 140 as contribution margin. We subtract the fixed, which is fixed manufacturing, fixed non-manufacturing. 20 plus 15 gives you 105. Right? I hope you got all the numbers. If you know, you can pause it and then read it later by yourself. Absorption costing, you have your revenue, subtract cost of goods sold. Got your gross margin, subtract your non-manufacturing, you got your operating income. So revenue 200, cost of goods sold, produced 5, sold 5, and then we said each one is 1 plus 2 plus 3 plus 20 divided by 5, right? It looks familiar, but I'll just do it one more time here to show you the numbers later. And then we times 5. So that is $50. Each one is $10. You sold 5, so your cost of goods sold will be 50. Gross margin 150. Subtract the non-manufacturing. Non-manufacturing 1 is sales administrative, 6 times 5, and plus your fixed sales administrative. So total will be 105. Found out. Operating income under variable costing and under absorption costing, they are the same, right? They are the same. Why they are the same? Because we said they subtracted the revenue, they are the same. And then your costs will be the same. That's the reason your operating income is the same, right? They subtracted the same amount of the costs, although at different place. For the variable manufacturing cost, we have 1 plus 3, 1 plus 2 plus 3. We have 1 plus 2 plus 3. So they both times 5, right? So that is the same there. You also have a non-manufacturing variable 6 times 5 here. You have 6 times 5 here. So those are the 30 there, 30 there. You have a $20 here as your fixed manufacturing cost, but you expense them as period cost under variable costing method. You expensed all of them. Expensed all of them because they are the period cost, right? Fixed manufacturing cost is the period cost. You expense them. So you subtract the $20. Here is for each one, you allocate the $4. You sold 5. So you also cost of goods sold, you subtract the $20 there, subtract $20 here. And then fix the non-manufacturing cost, subtract the 15 there, subtracting 15 there. So you subtracted all the same amount, but at different place. But okay, we said it's like a puzzle. No matter you put the circle first, or you put the triangle first, or you put the triangle first, the circle later, or it doesn't matter, as long as they are the same amount. So that's the reason we got 105. Okay, next one will be, how about our second year? How about our second year, right? What is our second year? So the second situation is you produced 5 bags. You produced 5 bags. You still produced 5 bags. So each one still has to be allocated at $4, right? But you only sold 3 bags at $40 each. You only sold 3 bags at $40 each. So now we still do our variable costing. We said it's still revenue minus variable cost gives you contribution margin minus fixed cost gives you operating income. So now your revenue is 120. You subtract the 1 plus 2 plus 3 plus 6. You times 3, right? 36 gives you contribution margin, which is 84. Subtract, still you subtract all of the fixed manufacturing cost because this is the expense, is the period cost. You just expense all of them. And then plus your 15 fixed sales, fixed non-manufacturing. So you got your 49 here. Under absorption costing, you have your revenue, you subtract cost of goods sold, or your gross margin, subtract the non-manufacturing, gives you operating income. Revenue is still 120. Cost of goods sold. Now, cost of goods sold. How many did we sell? We only sold 3. We only sold 3. For each one unit, the inventoryable cost is, for each one unit, is 1 plus 2 plus 3 plus 20 divided by 5. You still produce the 5, right? So this is 1 unit. This is 1 unit of our inventoryable cost. Now, we cannot time 5. First situation, you sold 5, you times 5. This time, you only sold 3, so your cost of goods sold will only times 3 because we only sold 3. We only sold 3 here, right? We only sold 3. So that gives you $30. And then your gross margin now became $90 minus your all of the non-manufacturing sales administrative now is variable 6 plus 3. You sold 3, and then you had that 15 fixed sales administrative. So your operating income now is 57. It's 57. You said, oh man, what's wrong, right? Why under one method is 49 and the other one is 57, and this is $8 difference. But why? You said why? So we look at the number. We try to find out the difference, right? Okay, 1 plus 2 plus 3, 1 plus 2 plus 3, and then you times 3. 1 plus 2 plus 3, you times 3. So it seems that one is perfect, right? They are the same. 6 times 3, 6 times 3, they are the same, no doubt. 15, 15. Okay, so what's the problem? Okay, here, right? What's the problem? Here is you subtract the total 20 of your fixed manufacturing cost as your period cost. You expense all of them. But here is you allocate to each one, and so each one is allocated to $4, but you only sold 3 units. So your cost of goods sold is only 60%, 3 out of 5 of the $20 can be expensed as cost of goods sold. So you only have expensed $12. Here you expensed $20. So that's the reason you have $8 difference. You have $8 difference. That is why you have $8 difference here. You subtracted 20 here, you subtracted 12 there. So you subtract $8 more. That's the reason the bottom number will be $8 less. So out of that $20 under variable costing method, you expensed all of it. But out of this absorption costing method, right? So we said for that $20 of fixed manufacturing cost, for variable costing, it's expensed all of the $20, right? It's expensed all of the $20 here. For absorption costing, what happened? For absorption costing is out of the $20, $12 went to cost of goods sold. $12 went to cost of goods sold because each one is allocated 4. You sold 3, so $12 is cost of goods sold. And the $8 is sitting as your ending inventory because you made 5, you sold 3, you still have 2 units left, and each unit is allocated the $4 of your allocated fixed manufacturing cost, right? So for the ending inventory, you have $8 there. So for your income statement, you have these 3 units. Each unit is $4. So you kind of broke this $20 to 2 parts. $12 is cost of goods sold. The other $8 is deferred because it's deferred at your ending inventory. You said go, right? They said, hey, I cannot go because you didn't sell us. You cannot put us to cost of goods sold until you sell us. Since you are not selling us, we will be your inventory. We are not going to operating income. We are not going to income statement. You cannot expense us because you haven't sold us. We are still sitting in your balance sheet as your ending inventory, as your assets. So that is why your difference is $8 here because of the $8 deferred. It's $8 deferred. Variable costing expense all of 20. Absorption costing expense 12. The other 8 is deferred until next time when you sell them. So this time you didn't subtract the $8. So under absorption costing, you subtracted $8 less, your operating income will be $8 more. Okay, I hope you got this one. So your $8 is because of the 2 units that are deferred. So this is the 2 units of your ending inventory. You produced 5, you sold 3, you have 2 ending inventory. Each one allocated $4 of the fixed manufacturing cost. How do you get this for? It's your 20 divided by 5, right? So that is why you have $8 difference. It's always your ending inventory time for each one you allocated the fixed manufacturing cost. Okay, year 3, you produced the 5 bags and you sold 7. Now you produced the 5 and you sold 7. So I'll do it quickly. Variable costing. Now you can even just imagine it will be opposite of your situation 2. Situation 2 is you produced 5, you sold 3, so you produced more than the sales. Situation 3 is you produced 5, you sold 7, so you produced less than your sales. So it will be opposite. So variable costing is your revenue minus your variable cost gives you contribution margin minus fixed cost gives you operating income. Revenue will be 280 and then variable cost is 1 plus 2 plus 3 plus 6 times 7 now gives you 84. And your contribution margin 196. Fixed cost is still 20 plus 15 gives you 49. Okay. And absorption costing is revenue minus cost of goods sold gives you gross margin minus your non-manufacturing gives you operating income. Revenue is still 280 and then cost of goods sold we said is 1 plus 2 plus 3 plus 20 divided by 5. So we already said this one is 10 and I'll just do it one more time. And you sold 7, so now it will be $70, right? So you go to 210, you subtract non-manufacturing, 6 times 7 units plus your 15 fixed sales gives you sorry, this is what I'm talking about. This is wrong. This is 161. Copy the wrong number. And then this will be 153. So you can find out there is $8 difference again. But this side is $8 more, so it's completely opposite. We double check one more time. 1 plus 2 plus 3 times 7. 1 plus 2 plus 3 times 7. So that one is the same. It's just different, place. And then 15. 6 times 7. 6 times 7. And you can find out now the difference is here. You just subtracted $20 of your fixed manufacturing cost as period cost. But here, you subtracted 28 because remember, you sold 7 units, right? This time you only produced 5, so you borrowed 2 from your last time. Remember, last 2, you had $8 deferred. Now this time, we go to your cost of goods sold. So your cost of goods sold is $20 plus the $8 deferred from your last year. So this time your cost of goods sold for your situation 3 is $28. It's $8 more than under variable costing. So you subtract $8 more for your costs, then your bottom number will be $8 less than under variable costing method. Okay, so I do the summary with you, and then we said our first situation is when production 5 equals to our sales 5, our operating income under variable is the same as absorption, right? We said second situation is when we produced 5, but we only sold 3, our operating income under variable is less than under absorption. The third situation is we produced 5, but we sold 7. So our operating income, we can say, is just the opposite of your second situation. And the difference, right? So you can even put the number. So I just copy the number very quickly. So it's 105 equals 105. This one is 49 less than 57. This is 161. 161 bigger than 153, right? Bigger than 153. So you can find out that the difference is 8. The difference is also 8. So you will find out that the difference. So the difference is your number of your ending inventory time your allocated fixed manufacturing cost for each one. So your ending inventory was 2 for second situation, and each one you allocated was total you spent 20, you produced 5. So it will be 2 times 4 gives you that $8. That's 8. That's the magic of our accounting numbers. That's the magic of our accounting numbers. So the third thing then is, the third part is some small things. So you want to know that absorption costing is for external reporting. This is consistent with the GAAP. You know, that's why you have learned multi-step income statement from your financial accounting. And then that's the only one for external, and also for the tax, also you use the absorption costing method. And then, so since your absorption costing method is used for the financial reporting, so you can find out the managers, and then they will realize that, hey, if this year I feel like I'm not going to meet my target, but there is a way I can improve my operating income, not by my really being better, just by being, you know, producing more units than my sales. Look at the situation 2. You didn't do anything different. All you did is you produced more than your sales, and you boomed your operating income by $8. So if you were the manager and you are evaluated based on absorption cost, what you will do? You find this so easy, right? You don't need to really work hard. All you do is you produce more. Then part of your cost of goods sold will be deferred. So you will deduct a lower number of your cost of goods sold to get a higher operating income. As the manager, what you will do, you will keep producing the product to get a higher number of operating income, right? So this, we call it earnings management through the real activity. Using accrual is one type, but using the real activity, you know, cut down expense or whatever, that's kind of good. But this one is you overproduce. That can also defer your cost of goods sold and to give you a higher number of operating income. This method is not right, it's not moral, it's not right, it's not encouraged, but in the reality, managers, they have the chance, they have the opportunity to increase their operating income by just producing more, which is called the real earnings management. Okay, I think that's all for chapter 9, cost inventory costing. So if you have any question, just let me know, and then I will post everything online. I see you next time.